Hi guys, so in today's lecture, we'll be looking at the instruments of fiscal policy. We know that in a government policy, there is monetary policies and fiscal policies. Okay, so there are in under monetary policies, there is interest rates and money supply, and fiscal we have tax and expenditure. Okay, so in a budget, we need to know this division, what all comes under budget, and all these subsections in order to understand the coming part of the video. And also we'll be doing a session on budget also. Okay, so we in order to understand all these aspects, we need to thoroughly understand what forms a part of a budget. So budget can be divided into revenue account and capital account. So under revenue account, there is revenue receipts and revenue expenditure. So under receipts, we have taxable receipts and non-taxable receipts. So under tax, we have income and expenditure. We have property, capital, commodities and services. So under non-tax, we have currency, coinage, minting, okay, creating new coins, and interest receipts and dividends are also there in non-tax receipts. Okay, in expenditure, we have general services like police, judiciary, etc. So in order to run that, government need to spend money on a day-to-day basis. So it comes under revenue account. Okay, economic services, agriculture, industries, transportation, trade, etc. And also we have the social community services. So all this comes under expenditure. Okay, now under capital account, we have receipts and expenditure similar to revenue account. Okay, what comes under capital receipts? We have net recoveries of loans and advances. We have net market borrowing, net small savings calculations, etc. And expenditure loans to states and union territories, social, economic and community development, defense, and others. So, when I said all these things, I know that you people would be confused. So, what are these terms and all? We are having certain level of confusion. No need to worry. In the coming sessions, we'll be dealing with it. So, fiscal policy is carried out by the legislative and or the executive branches of the government. The main instruments of fiscal policy are government expenditure and taxes. Okay, the effect of government expenditures, taxation, and debt on the aggregate economy is of immense importance. The government collects taxes in order to finance expenditures on a number of public goods and services. So, fiscal policy is a government initiated measure to alter the tax rates and government spending for creating macro level impact on the nation's economy. So, on a large scale, there should be some impact. So, in order to do that, we do fiscal policy changes. Okay. So, economic expansion in case of inflation, contradictory fiscal policy. So, decrease government spending and increase taxes. In the case of economic contraction, that is in case of deflation, we have expansionary fiscal policy, that is increase government spending and decrease taxes. Okay. What is government expenditure? That is public expenditure. So it is also known as government expenditure, which can be classified under the following heads. So first one is capital expenditure. These are those government expenditure which result in the creation of physical or financial assets or reduction in financial liabilities. These include expenditure in the acquisition of land, building, machinery, equipment, investment in shares. So capital expenditure is basically that expenditure that in order to generate revenue, in order to generate income, we do infrastructure development. So all these kind of things that happens in order to create an asset by the government is called capital expenditure. Okay, second is revenue expenditure. So what is revenue expenditure? Revenue expenditure is basically day-to-day expenses rather than the creation of physical or financial assets. So day-to-day expenses incurred in normal functioning of the government departments and various services, interest payments of, so if government has taken loan from a financial institution, so in order to pay that on a day-to-day basis, so that comes under revenue expenditure. So day-to-day expenses of the government comes under revenue expenditure. So next is government revenue. Okay, government revenue is classified into revenue receipts. So these are those receipts of the government which are non-redeemable, that is, they cannot be reclaimed from the government. They are further divided into tax and non-tax revenues. So tax revenues. Tax revenues consist of the tax proceeds of taxes and other duties levied by the central government. Okay. Tax revenues are an important component of revenue receipts and comprise of the following taxes. What are the different types of taxes? First one is income tax based on salaries, corporate tax taken from firms and corporations, excise duties, duties levied on goods produced within the country, custom duties imposed on goods imported into or exported out of India, then service tax levied by the government and service providers on certain service transactions. Next is wealth tax, charged on net wealth of the assessed. Okay, if a tax on the benefits derived from ownership of property. Last one is gift tax. Okay, tax on the transfer of property by one individual to another while receiving nothing or less than the full value in return. So, third is non tax revenue. What is non tax revenue? It consists of interest receipts on accounts of loans by the central government, dividends and profits on the investments made by the government. So, we have seen in the news that government has, when the COVID-19 hit India, government told the oil marketing companies to increase the dividend so that government can earn a large amount of money from the dividend income. Okay, so that comes under non-tax revenue. Okay, fees and other receipts for services rendered by the government and cash grant aid from foreign countries and international organizations. So we will go again. In revenue we have receipts and expenditure. In the receipts we have tax, direct and indirect tax, and non-tax, so selling goods and services, dividend and profit, interest, grants received. Okay, in expenditure we have the interest paid, subsidies, salaries and pension, and grants given. So, fourth one is capital receipts. All those receipts of the government which create liability or create financial assets are termed as capital receipts. Okay, main items of capital receipts are loans raised by the government from the public, which is known as market borrowings. Next is borrowings by the government from the RBI and the commercial banks and other financial institutions. Okay, by selling treasury bills. Third one is loans received from foreign governments and international organizations. Okay, recoveries of loans granted by the central government. Small savings banks and all provident funds, net receipts obtained from the sale of shares of public sector undertaking. So, with that, I hope today's session was productive for you guys. So, until we meet again, God bless you all. Jai Hind.